There is a building in Basel, Switzerland, that looks like it was designed to be forgotten. Glass, steel, clean lines, no spectacle. You could pass it 100 times and never feel the urge to stop. And that is the point, because the institution inside has spent nearly a century proving that real power in finance does not need a flag, a ballot, or an army. It needs a place where the people who run money can meet, coordinate, and move assets that governments treat as sacred. That place is the Bank for International Settlements, the BIS, an organization so structurally unusual that even its critics often describe it the same way. A bank for central banks, operating above ordinary political noise. Now, a warning before the story turns dramatic. The internet loves to turn the BIS into a single villain with a single plan. Real history is messier. But there is still something quietly unsettling here. Because when you strip away the slogans, you find a repeat pattern that is not a conspiracy theory at all. Central banks have repeatedly used gold as a tool of coordination, crisis management, and credibility, often with limited public visibility, and sometimes with decisions that later became deeply controversial. During the Second World War, the BIS did not shut its doors. It continued operations, and its wartime record is still debated, precisely because gold moved through this system while Europe burned. The BIS Historical Archive itself documents how questions over looted gold and wartime gold operations became part of the post-war controversy around the institution. This is not a rumor. It is preserved in the bank's own historical material, and it sits there like a stain that never fully washes out. Fast forward into the Bretton Woods era, and you meet the next chapter. Not secret cabals, but coordinated policy. In the early 1960s, major Western central banks formed what became known as the London Gold Pool to defend the official gold price linked to the dollar. It was, in effect, a multinational attempt to stabilize a system whose credibility depended on gold's price, not screaming, "The promise is breaking." It worked until it did not. By 1968, the arrangement collapsed under pressure, and the global monetary order began sliding toward the moment most people remember. The United States closing the gold window in 1971. So if you take only one idea from this opening, the hidden gold network is not one hidden tunnel. It is a series of institutional mechanisms, some public, some technical, some opaque by design, that let central banks treat gold as a reserve asset even when the public is told gold no longer matters. And once you see that tension, you start asking better questions than the ones conspiracy videos want you to ask. To understand why gold never truly disappeared from the system, you have to step back to a moment most people think they already understand, but usually don't. Bretton Woods is remembered as a clean reset, a grand conference where 44 nations agreed to build a stable post-war financial order. The story is often told as if gold sat proudly at the center, then exited the stage in 1971 when Nixon closed the gold window. But that version leaves out the machinery that made the system function day to day. The practical problem was never ideology. It was logistics. Moving physical gold across oceans to settle balances between nations was slow, risky, and politically sensitive. Central banks needed a way to treat gold as money without constantly touching it. That is where the architecture quietly solidified. Gold did not need to move if ownership could be adjusted on ledgers. Claims could be netted. Balances could be settled without headlines, ships, or cameras. The BIS became a hub for that process, not as a mastermind, but as an institutional convenience that gradually accumulated influence precisely because everyone relied on it. This mattered because it created a split reality. On the surface, the public saw currencies, exchange rates, and policy statements. Underneath, gold was still being treated as a final settlement asset between institutions that did not fully trust one another's paper promises. Gold was not everyday money, but it was still ultimate money. And that distinction allowed governments to tell two truths at once. Gold no longer mattered to citizens, but it still mattered when trust between states was on the line. By the late 1950s, this contradiction was under strain. The United States was issuing more dollars than its gold stock could credibly support. Officially, an ounce of gold was worth $35. Unofficially, demand was telling a different story. Central banks understood the danger immediately. If gold's market price broke free, it would signal that the dollar's promise was failing. That signal could not be allowed to flash. The response was not chaos, it was coordination. The London gold pool was not created in secret panic, but in cold institutional logic. Gold would be supplied to the market when demand rose, suppressing price signals that could destabilize the system. This was not about enriching bankers. It was about preserving confidence in a monetary order built on credibility rather than metal. But credibility, once defended by manipulation, becomes fragile in a different way. And when the gold pool finally collapsed, it did not destroy gold's role. It simply forced it deeper into the plumbing, away from public view, where it could continue doing what it had always done, settling trust when paper alone was no longer enough. By the time the gold pool collapsed in the late 1960s, the system faced a problem it could no longer disguise. The United States could not honor foreign claims on gold at the official price without draining its reserves entirely. Other nations could see the math. France acted first, not out of ideology, but arithmetic. When dollars were exchanged for metal, and ships were sent to collect it, the message was unmistakable. Confidence was breaking at the sovereign level. What followed in 1971 is often described as a clean break. Nixon closes the gold window. Gold is demonetized. The world moves on. That story is tidy, politically useful, and incomplete. What actually happened was not the death of gold, but its removal from public discipline. Gold stopped being a promise governments made to citizens, but it did not stop being a tool governments used with each other. Once currencies floated, central banks gained freedom. They could issue money without immediate metal constraints. But freedom did not eliminate fear. A purely paper system depends entirely on confidence, and confidence is not evenly distributed in moments of crisis. When currencies wobble, when debt levels stretch credibility, institutions still look for an anchor that does not rely on promises. Gold quietly filled that role. This is where the narrative split widened. Publicly, gold became a barbarous relic, an asset without yield, a curiosity for pessimists. Privately, central banks never stopped holding it. They adjusted accounting classifications. They changed language. But they did not liquidate it. In fact, in moments of stress, gold reappeared as a stabilizing instrument through swaps, leases, and off-balance sheet arrangements that never showed up in press conferences. These mechanisms were technical, not theatrical. A gold swap could provide temporary liquidity without selling reserves. A lease could generate income while keeping metal on the books. On paper, nothing changed. In reality, gold was being mobilized as collateral, insurance, and trust capital in a system that claimed it no longer mattered. The public saw fiat. The institutions saw fallback. This duality explains something that otherwise looks contradictory. If gold truly lost relevance after 1971, central banks would have sold it. Many did not. Some repatriated it decades later. Others quietly accumulated more. The behavior makes sense once you accept the uncomfortable truth. Gold's power lies not in daily transactions, but in moments when systems fail and narratives collapse. Gold did not disappear. It went silent. And silence, in finance, is often where the real decisions are made. Once gold was pushed out of public money, the system needed a replacement signal. Modern finance cannot function if markets constantly question the credibility of currencies, so gold had to be neutralized without being eliminated. The solution was not to ban gold, but to bury it under layers of abstraction. This is where the paper gold market emerged as one of the most effective financial instruments of perception ever created. On the surface, paper gold looks like access. Futures contracts, exchange-traded products, unallocated accounts, and derivatives all promise exposure to gold's price without the inconvenience of holding metal. For traders and institutions, this is efficient. For the system, it is essential. Paper claims can be created in volumes that physical gold never could match. That elasticity allows supply to expand instantly when demand spikes, smoothing price movements that might otherwise send uncomfortable signals about currency stability or inflation. The crucial point is not fraud, but structure. Most participants in the paper gold market are not seeking delivery. They want price exposure, hedging, or short-term profit. As long as that remains true, the system functions smoothly. Prices are discovered in liquid markets. Volatility is managed. Confidence holds. But the structure carries an unspoken assumption. Only a tiny fraction of claim holders will ever ask for the metal itself. This assumption is what creates the illusion of abundance. When hundreds of paper claims exist for every ounce of physical gold, the market price reflects promises, not scarcity. That disconnect matters, because gold's historical role is precisely about scarcity and final settlement. When paper claims dominate, gold behaves like any other financial asset. When confidence breaks, it reverts to what it has always been. Central banks understand this distinction better than anyone. They do not rely on paper claims when trust erodes. They rely on allocated metal, stored, counted, and quietly accounted for. This is why physical gold moves between central banks even in a world awash with digital liquidity. It is why gold swaps exist. It is why gold reappears in moments of crisis despite years of official dismissal. The paper gold market does not exist to deceive individuals. It exists to prevent gold from revealing stress too early. As long as price signals remain muted, policymakers gain time. Debt can roll. Currencies can inflate gradually. Adjustments can be postponed. But postponement is not resolution. It is simply delay, disguised as stability. And every delay increases the significance of what happens when paper promises and physical reality finally collide. Every monetary system ultimately rests on one fragile foundation: trust. Not mathematical models, not legal frameworks, but belief that the assets backing the system exist as claimed and can be used when needed. This is where the story of gold becomes psychologically powerful. Because gold is one of the few assets where trust and verification are inseparable. Either the metal is there, in the quantity and quality claimed, or it is not. Fort Knox sits at the center of this tension. It is presented as the ultimate symbol of monetary certainty. Thousands of tons of gold, immovable, guarded, unquestionable. Yet certainty fades when verification disappears. The last comprehensive public audit occurred generations ago, in a financial world that no longer exists. Since then, reassurance has replaced inspection. Statements have replaced evidence. And for a system that once insisted on convertibility and proof, that shift matters. This does not require dramatic conclusions. Gold does not need to be missing entirely for the problem to exist. Modern finance has introduced layers of ownership that complicate the simple question of possession. Leasing, swapping, pledging, and rehypothecation all allow the same asset to support multiple obligations over time. The gold can remain physically present, while its economic ownership becomes fragmented. That fragmentation is not illegal. It is standard practice in complex financial systems. But it undermines the clean narrative that the gold belongs, unequivocally, to one sovereign entity. Why does this matter? Because confidence depends not only on existence, but clarity. A system can survive ambiguity during stability, but ambiguity becomes explosive during crisis. If markets ever questioned how much gold was truly unencumbered, or how much could be mobilized without triggering claims elsewhere, confidence in paper promises would weaken rapidly. That is not speculation. It is a pattern repeated throughout financial history. This is why transparency around gold is treated differently from transparency around most other assets. Detailed disclosure invites uncomfortable questions. It forces institutions to explain arrangements that function best when left technical and obscure. Silence becomes policy not because of a single hidden truth, but because complexity itself is destabilizing when exposed. Gold's power, in this sense, lies less in what it is than in what it represents, a boundary beyond which trust must be earned, not declared. And boundaries are exactly what paper systems prefer not to acknowledge. If gold were truly irrelevant, central bank behavior over the past 2 decades would make no sense. Yet the pattern is unmistakable. After years of selling or sidelining gold, monetary authorities reversed course. They did not announce a philosophical shift. They did not explain it in press conferences. They simply began accumulating again, steadily, methodically, and with minimal commentary. This return did not happen during prosperity. It happened after repeated shocks exposed the fragility of the paper system. The global financial crisis demonstrated how quickly trust between institutions can evaporate. The pandemic showed how aggressively money could be created without immediate consequence. Rising debt levels revealed a problem with no politically acceptable solution. In that environment, gold's appeal is not nostalgia. It is risk management. Gold has no counterparty. It does not depend on another institution's promise to pay. It does not default, restructure, or require bailouts. That quality becomes decisive when every other asset in the system is someone else's liability. Bonds depend on governments. Deposits depend on banks. Reserves depend on central banks. Gold depends on nothing but its existence. This explains why gold buying has been strongest among countries most exposed to geopolitical and financial uncertainty. It is not preparation for a return to a gold standard. That is a distraction. The real objective is optionality. Gold gives central banks flexibility in extreme scenarios. Sanctions, currency, crises, breakdowns in payment systems, or sudden loss of confidence in reserve currencies. At the same time, the narrative aimed at the public has barely changed. Gold is still framed as unproductive, speculative, or obsolete. That messaging serves a purpose. If gold were widely perceived as essential, demand would surge, prices would rise, and the signal would become impossible to suppress. A rising gold price is not just a market event. It is a commentary on the credibility of paper. So, the system maintains a delicate balance. Institutions accumulate quietly, while discouraging public attention. Gold remains present but politically invisible. It is acknowledged just enough to function, and dismissed just enough to avoid panic. This is not contradiction. It is design. And the design works only as long as confidence holds. Every financial system survives on belief longer than logic says it should. Debt can grow beyond repayment. Currencies can expand far faster than production. Markets can price risk as if history has been repealed. What sustains all of it is confidence, the shared assumption that tomorrow will resemble yesterday closely enough to roll obligations forward one more time. Gold exists precisely at the moment that assumption fails. This is why the story of gold is never loud during stability and never quiet during collapse. When confidence holds, gold looks unnecessary. When confidence cracks, gold stops being an investment and becomes a verdict. Paper assets argue about price. Gold settles questions of solvency. That is the difference institutions understand instinctively, even when they avoid saying it aloud. The hidden gold network is not a single conspiracy pulling strings behind a curtain. It is something more durable and more unsettling. A system of incentives that quietly preserves an escape hatch for those closest to power while the public is taught to trust abstractions. Gold is kept in reserve not because collapse is inevitable tomorrow, but because history says it is inevitable eventually. Every major monetary order has ended the same way. Credibility first questioned, then defended, then abandoned. What makes this era distinctive is not that gold still matters, but that it matters asymmetrically. Institutions hold it. Systems rely on it in extremis. Yet, the public is discouraged from understanding why. That gap is where fragility grows. When too many people discover too late that promises cannot be redeemed simultaneously, the adjustment is never gentle. This is not an argument that paper currencies are about to vanish overnight. It is an argument that the system's safety net is not what it appears to be. Gold remains the final asset not because it generates returns, but because it ends debates. It does not require belief. It requires possession. History's pattern is clear enough to ignore only once. Systems built on trust can function for decades, even generations. But when trust is spent faster than it can be rebuilt, something real always re-enters the conversation. Gold does not predict collapse. It reveals it. And that is why it is still there, still guarded, still quietly accumulated and still spoken about as if it no longer matters.